Hi, my name is Matt Kunke. I'll be presenting my analysis on Taiwan Semiconductor.
Taiwan Semiconductor is the world's largest pure-play semiconductor foundry. They operate in discrete semiconductors, sensors, and all the subsegments of the integrated circuits market. Industry growth rates are forecasted to be slowing relative to historic rates due to the high cyclicality of the industry and slowing world economy. The vast majority of the revenue is coming from North America, and this disparity is looking to widen as semiconductor growth in the Americas is forecasted to exceed the broader world growth rate. Taiwan Semiconductor appears to be the most attractive investment out of our customized peer group based on the Holt scorecard, which attempts to objectively break down the relative attractiveness of an investment based on operational quality, momentum, and valuation. Now, to get a better bottom-up understanding, we will apply the Holt valuation methodology. Prior to 2001, there was a large variance in CFROI levels and a drop below the discount rate in the late 90s. An uptrend began in 2001, and CFROI increased each year until 2004. Since 2004, CFROI has consistently been in the range of 2 to 3 times the discount rate, and the low variance is a large factor as to why the model has a slow rate of fade. This leaves us with a large margin of error for CFROI to decrease in the future without destroying value. Management has recently done well managing assets, but their decisions destroyed shareholder value when they increased assets in the late 90s with CFROI levels less than the discount rate. However, I believe my previous statement may hold more weight theoretically than practically in this industry. Developing new process technologies requires cyclical multi-billion-dollar investments into new fabs. Delaying investments when competitors are making them could put one behind technologically and potentially lead to bankruptcy. Regardless, Taiwan Semiconductor's impressive performance in recent years has seemed to be under-recognized by the markets, and the default Holt model is projecting a warranted price increase of 81%. To further understand this investment, we can more cautiously analyze CFROI by looking at the sales, margins, and turns. Since we are analyzing a business that only operates in the foundry segment, our sales are not diversified and thus our understanding of the industry trend is paramount in forecasting sales. Taiwan Semiconductor's operations utilize advanced and mature process technologies. From the graph, we can see that an increasing percentage of their revenue is coming from advanced technologies, and this supply is almost exclusively reserved for Apple. I believe Apple will alleviate the iPhone's dependence on Samsung by sourcing their A10 chip entirely from Taiwan Semiconductor. This will greatly increase sales from Q4 2016 throughout 2019. However, to avoid being overly optimistic, I will include an increase in sales attributed to the Apple A10 only in 2017, and future year sales will fall to the historic CAGR. Since 2001, asset turns have been range-bound and margins have been consistent with the exception of one outlier. Due to the historic consistency, I forecasted these components by simply holding forward a 5-year average. Due to lack of management guidance, I will assume the previous year's effective rate will remain constant. Using these assumptions in the flex valuation model, we see that we still have a large margin of safety with a 37% warranted upside. In conclusion, Taiwan Semiconductor will outperform because there is a large market in need of advanced process technologies for SoC fabrication, and the market has significantly overestimated the rate of CFROI fade.